Hey, good morning. Accounting 230, section 40998. We're going into chapter 12 now. Let's see if anybody joins us. Hello, Zuzi. I see you're joining us today. How you doing?
Unmute. Good.
All right. All right.
Wonderful.
We're getting into a tricky area here, Zuzi. The statement of cash flows. The only way you learn this is by doing them and not memorizing, but understanding some of the rules involved, okay? What we're trying to do is we're going to look at the cash at the beginning of the month, right? And we're going to look at the cash at the end of the month and subtract the two. That difference in cash has to be broken out into three types of cash flows: operating, investing, and financing. And they each have their different rules, okay? So let me share a screen with you. Okay.
I see.
Okay, let's see what we got here. Hold on one second. Let me stop sharing for just a second. Okay. Okay, Zuzi, here we go.
I see.
The useful, okay, good. I'm glad you mentioned that because I'd be a little annoyed if we missed it. Discuss the usefulness and format of the statement of cash flows, prepare a statement, and use it to evaluate a company, okay? The usefulness of a cash flow. What this is going to do for us is going to let us assess an entity's ability to pay their bills. It'll tell us where they're getting their cash and where they're spending their cash. And it's a very, very important financial statement that is normally prepared along with the income statement, retained earnings statement, and balance sheet. And we have three classifications, Lucy: operating, investing, and financing. And we're going to break those out based on certain rules. So what are operating activities? Operating activities, let's put it this way. If you never borrowed money and you never invested anything, everything would be an operating activity. Coca-Cola bottles soda. So any expenses Coca-Cola has towards selling soda is operating. They buy their raw materials. They pay people to mix the soda. They pay their employees. They sell soda. They collect money from customers. They pay vendors. Operating is the normal course of a business's activities, and it is the one area of the three here where we want to see the positive cash flows, okay? Investing, here, we're talking about you bought a fixed asset or you bought stock or a bond in another company, and that would be a cash outflow. And of course, if you sold them, that would be a cash inflow. Then you have financing, which is simply borrowing money or raising money with a stock issue. So the first thing to get in our minds is we're going to have a cash flow statement broken out among operating, investing, and financing. We also have to deal with non-cash activities. They're giving you some esoteric ones here. What we're really talking about, class, is depreciation, perhaps amortization, depletion, a sale of a fixed asset. Gain or loss needs to be put there. So here is a summary look at your statement of cash flows. You have cash flows, net cash provided by operating, net cash provided by investing, and by financing. We add those three together, and that number will match the difference in the cash from month to month, okay? We want to tell management that cash went up $1 million, and so much of it was due to investing, financing, and operating. And they're just giving you some categories. You issued stock to the public. That's financing. You borrowed money, that's financing. You bought a big truck like this, that's investing. Well, paying employees, collecting cash for services performed, that's clearly operating, okay? Prepare a statement of cash flows using the indirect method, which is the only method, the only approved method,
Okay.
the GAAP method, right? Prepare the statement of cash flows with the indirect method. We need three things to be able to do a cash flow statement. We need a balance sheet for the current year. Let me start again. We need an income statement for the current year, and we need a pair of balance sheets for the current year and the prior year, because we're going to be comparing them. So that's what we need, 2 balance sheets and 1 income statement. And then there will be additional information that must be given to us, or a trail given to us how to get it. So how to steps to prepare a statement of cash flow. Determine net cash provided used by operating activities by converting net income from an accrual basis to a cash basis. What we're saying there, Susie, is we're going to take the net income, which is, as you know, is an accrual-based number, and we are going to add back to it the non-cash activity, like
Okay.
depreciation. And what that does is change the accrual net income to a cash basis net income. So let's see how we do it. We're going to analyze the changes in non-current assets and liability accounts, equity, compare the net change of cash differences. Companies favor the indirect method for 2 reasons: easier, less costly, and it truly does break out the differences between net income and the cash flow from operating activities. So here's our income statement. We had net income of 145,000, huh? And there is our balance sheet, the first page, the asset, and there's the second page, the balance sheet. So we have 2 balance sheets comparing to each other. And then they're telling us
Still the same, like the assets, everything is stated by liquidity. How it goes.
say that again.
The balance sheet, everything is stated by liquidity.
Yes, yes, current assets and current liabilities by liquidity, absolutely. Cash, accounts receivable, very liquid, inventory, prepaid. And then here, accounts payable, income tax payable, liquid. Does that answer your question, Susie?
Yeah.
Okay, so we're trying to do this operating cash flow, and they're giving us other information. They're telling us what the depreciation is. They had sold equipment with a book value of 7, less accumulated, so they have a loss there. They issued some bonds, so we're going to need that information later. And I'm warning you guys in the class, the cash flow statements are a little bit tricky until you do a couple of them. The easy way to learn it, though, is piece by piece. So we're starting with just the operating portion here. What is the cash flow from operation? I'm skipping that. Operating activities, here we go. Start with the net income, add back the non-cash activities. So here is the start of our cash flow statement, Susie, the very top. You start with your net income. And look what we did. We added the depreciation expense. That changes that 145 from an accrual-based number to a cash-based number, okay? Because that 9,000 is expensed, even though it was not cash. So if we didn't have that, expense at all, we'd have a profit of 154. Now we have a loss on disposal of a fixed asset that needs to be added back, because that loss is part of the net income, and such a loss is not operating, and we want to take it out of the operating area. So now we have 2 things. We added back the depreciation and the loss. Now, Susie, here we go. Here is the key rule. We are now going to look at every current operating asset, and every current operating liability. We're going to compare the two numbers, and the difference is going to go on our cash flow statement. The question is, does it go on as a cash inflow or outflow? You see here the T account for accounts receivable, we had a beginning balance of 30, right? The ending balance was 20. That is a positive cash flow. And an increase in a current asset is a negative cash flow. It's no good cash flow wise. And let's think about why. We have accounts receivable. We started off with 10 and we ended up with 20. When we started off with 30, we started off with 30, we ended up with 20. That means that we collected more than we billed out. When does the asset go down? When we're paid on this side, right?
Yes.
So a decrease in a current asset is a positive cash flow. Positive, an increase would be a negative cash flow. And that's counterintuitive, and you just got to think your way through that. So here's how it looks on the cash flow statement. We add it back just like that, okay? So far we have our net income. We added back the non-cash items, and now we have 10,000 decrease in accounts receivable, which is favorable, which is good. Inventory went up. That's a negative cash flow, because when does inventory go down? When you get paid, right? Inventory goes down when you sell something. So if inventory goes up, that's a negative cash flow. And there it is, 5,000 negative. Prepaid expenses, the same thing. We'd have to look at that balance sheet. And if we looked at the balance sheet, we would see there was a $6,000 increase, which is unfavorable. We have to do the same thing with accounts payable, except here, you don't have to worry about the sign control. If accounts payable goes up, that's good. If accounts payable goes down, that's bad cash flow wise, because when does accounts payable go down? Only when you pay somebody, right?
Yes.
So if accounts payable went up, cash flow wise, that's good. It means we got something for free. We haven't been forced to pay for it yet. So at this point, we have finished with the net cash provided by operating activities, 172. We can go to the boss right now and say, hey, boss, we generated operationally 172,000 in cash flow. Now let's go to the other portion, the investing and financing. This piece of paper you see in front of you here, this would be a good thing to print out and have in front of you while you're doing your homework. It gives you the summary information, what we're talking about. Okay.
Screenshot. That's a slide number 36.
36.
Yeah. I'll print it out.
Don Newcomore, number 36. Cash from operating activities. All right, you want to try to do this one together, Susie?
Yeah.
Okay. Josh's Photo Plus reported net income of 73. They had depreciation expense of 7, and this time they had a gain, not a loss, on a fixed asset. And they're showing us the changes in their two current assets. Accounts receivable went up 4, and accounts payable went down, looks like 3,800.
So they got paid.
Right. That's because we made a payment. So accounts payable went down, that's no good. And accounts receivable went up, that's no good cash flow wise. So how would we do it? We're going to take the net income of 73. We know we add the depreciation expense, right?
Yes.
And we know that we subtract the loss on a sale of a fixed asset. Therefore, we're going to add the gain back or subtract the gain. And then we have 2 unfavorable.
So that will end up 80,000 minus.
There it is right in front of you here.
Yeah, I see. 250. So depreciation we add, gain we take off, increase we take off, and decrease we take off, and then we'll get the net cash. Yeah, I do screenshot this one
Yep,
too.
Yep, so these are the kinds of problems you'll be doing for your homework.
Yeah.
Now, let's get involved with investing. The rest of the cash flow statement, I think, is a little bit easier because it's cut and dried. They have to tell you. They're saying right here, company purchased land by issuing bonds. Okay.
Mhm.
So they what did they do? That's a cash
They-
outflow. They spent money, right?
Yes.
So that's going to be a negative 110,000 when you come to the investing section. Oh, I'm sorry. I'm sorry. Issued. Oh, they issued bonds. Okay. No, they raised money with a
They
bond.
purchased land.
I thought it was the other way around. Yeah. What they did was they borrowed money, basically, is what they're saying here. Company purchased land. Yeah. We don't care about that yet by issuing long-term bonds. Okay. So
we add it.
they add it because they borrowed the money. Okay. Next, the company paid cash for an office building. So that's negative cash flow. It's simple as that. Minus 120. Okay. Minus 120. Increase in equipment. Okay. The equipment account went up, but we have to pick the bones. We have to know what the pluses and minuses were. So
when we purchase an equipment,
yeah,
it goes up.
Yep. So when we purchased the equipment, that's a negative cash flow. And then we sold a piece of
That
equipment.
goes into positive cash flow. Yeah.
Yeah. Yeah, exactly. So the difference is 17,000. 25 minus the 8. And there it is right there.
Yes.
Well, that's the journal entry. All of a sudden they're showing us journal entry. Oh my goodness. Can you read that?
Yeah.
Yeah. There's the 25. And
Purchase
there's
equipment, we have to subtract it when we sell equipment.
Exactly. And there's the sale there of the equipment.
Net cash.
Yeah. Common stock went up.
So if we issue new shares, that brings the stock up.
Positive cash flow. Yeah. That's why this section is a little bit easier. Okay.
Yeah.
I'm looking for the 20,000 there. Oh, there it is, right in red.
Yeah.
Okay. Retained earnings went up. It went up for two reasons. One reason was net income, right?
Yes.
We already recorded the net income on the cash flow statement, right, Susie? That was the very first line. So we can ignore that. The dividends are a negative cash flow, $29,000. Right there.
Yeah, we can see it.
Okay. So I think you can kind of see how this thing is being driven. Net change in cash.
It's really just going step by step.
It's exactly right. It's just like climbing a ladder. You get the first step done, you get to the next one. Compare the net. What's this one here? Is this another problem? Then compare the net change in cash on the statement of cash flows with the change of cash. So what they're saying is that the cash went up $22,000, and they're showing you a couple of components of it. I'm not sure what they're trying to tell us with this. Other we can practice. Accounts receivable went up, so that's a negative cash flow, right?
Yes.
Inventory went down, that's a positive cash flow increase. And now we're going to use the statement of cash flows to evaluate a company. And there's a nice looking bunch of squiggles. Free cash flow. What's free cash flow? It's your operating cash flow minus capital expenditures and cash dividends. In other words, we had $1 million, say, in operating activities, right? Operating cash flows.
Yes.
That means that's $1 million we can maybe spend to do whatever we want. But we're gonna set some aside for capital spending. We're gonna set aside 200,000 because we want to buy that big machine we've been looking at. And we want to pay dividends of 100,000. So the free cash flow would be, in that case, 700,000.
How to calculate it?
Here, they're just showing a partial of the cash flow statement. They're showing the investing section. And notice they have the additions and the sales. Everything is broken out in detail. There's none of this, what's the change in retained earnings? You need to know, you got to pick the bones. You got to look at what all the debits were, what all the credits were, and work them through. Free cash flow, net cash provided by operations, 63,598 minus dividends and minus expenditures on plant and equipment. Okay. And we're not going to go into the direct method at all. I am not going to go into this. I don't think. Okay, I'm going to cut us off here. I'm not going to go into the direct method because nobody uses the direct method, and it's very cumbersome, very, very goofy to put together for something that's really not GAAP friendly.
Okay, so in in real life, it's not really used.
Yeah, no, in real life, it's not used. It's used by companies who want to do something. What's the word I want? Something that is clear to somebody who's not familiar with financing at all. But it comes across as too simple, actually, to be of any real use. Okay. Now, in the real world, when I did cash flow statements, I did them this way, with the T account. We had a small enough company where I could get away with it. And one way to do it is by looking at your T accounts. See the T account here? See cash?
Yeah.
I would simply go into the T account for cash and mark every single number. See how they did it here?
Yeah, that's how we learned it when I was in the school 30 years ago.
Yeah, yeah.
We had P accounts. It's just in Europe, the account, accounting is little different.
Yeah. So anyway, I'm going to cut the lesson off there. I'm going to ask Cornelia if I should have taught the direct method.
Okay.
And if I needed to do it, we can always catch up in Tuesday's class, okay?
Yes.
All right, so how you doing? You're keeping busy with the water rights?
Oh yeah, you know, we are late on taxes, so it's just a hell right now.
Oh, really? Really? Well, you're doing important work for us. Keep the water flowing, Susie, okay?
Yeah, right.
All right, you take care. You have a good weekend.
You too have a wonderful day. Bye-bye.
See you. Nah, bye-bye.
See you.